our next speaker is Rex Crandell, and Rex is here, and Rex is going to talk to us about tax considerations. Hi, Rex. How are you today?
I'm great. Yeah, I'm looking forward to making this presentation on tax topics.
Well, you can start when you're ready.
Okay. So, about me, I've been doing income tax since 1976 and doing wills, trusts, and estates since I became an attorney in 2002. But I've always worked in the area of wills, trusts, and estates in the tax area, in addition to doing estate planning and estate administration. And I have a real estate broker license also, which helps in deeds and real property transactions. But primarily, I'm heavily involved in this particular area. Some of the pitfalls for estate planning and tax, some law firms will say, we're going to help you with the estate planning issues, but you've got to go to another firm for tax matters. And if the attorney handling the case has no idea what the tax matters are, sometimes they can be overseen or overlooked and come back to bite the client later. And knowing the tax laws, you can plan around it. We have special rules in California relating to real property tax and after death reassessments and things like that. Simply advising a client to get tax advice is not efficient. What law firms do will bring a tax counsel in during the planning or estate administration process to handle every question that comes up and be a known contact point for the client. When there's several areas of tax in the area of estate planning, there's estate and inheritance tax, there's gift tax, there's income tax for the decedent, income tax for the estate and trust, and there are real property and transfer tax issues. And some states have inheritance tax taxing the beneficiaries. One of the areas that's handled heavily in a lot of continuing education programs is the area of inheritance tax or estate tax. It's really the Uniform Estate Tax, IRS Form 706. Now, this is a fact, it's in the law. And when I started, inheritance tax was effective when you had estates over $625,000. Now, things have changed quite a bit, and the exemption is quite a bit higher. It's around $14 million per person, $28 million for a couple, and then the inheritance tax kicks in. But my point being, with the high level of assets being transferred, effectuating the need to file an inheritance or estate tax return, it's a very low percentage that actually takes place in the United States. It's like less than 1% of the states need an inheritance tax return now. And above that threshold of value, market value of assets, then the inheritance tax is applied, proper name being estate tax. So the actual numbers for 2025 are shown on the screen. And then next year in 2026, the exemption drops. It's statutorily going to drop to $7 million per individual, or $14 million per couple. So next year, unless the estate tax is changed, a lot more estates are going to be subject to this estate tax. And my point being about the low percentage of estates applying the estate tax, oftentimes I think some of the educational programs go into extensive length of discussion on this topic, and it is just not that frequent. When you have a person who dies and they don't use up in the current year 14 million, let's say they had an estate of 10 million for the spouse who died, then you can file an estate tax return and claim exemption to the 14 million before the estate tax is effective. And that 4 million that was below the threshold of estate tax can be transferred to the surviving spouse, and this year giving the surviving spouse her original 14 million plus the additional 4 million. In order to claim that transferability or portability of the lifetime exemption to estate tax, you must file the IRS Form 706, and even though there's no tax on it, it must be filed with the IRS so that you can claim that portability. In another salient tax issue is when you're working with a couple and they say, a husband and wife, and let's say the wife is not a U.S. citizen. Well, that's a big red flag for estate tax on IRS Form 706, because estate tax kicks in at $175,000, and all the assets going to that non-citizen spouse are taxed at 40%. So it's not the normal rules of the 14 million or the 7 million exclusion next year. The way that we do planning around the non-citizen spouse is that we create a trust called a Qualified Domestic Trust, QDOT. The Qualified Domestic Trust has statutory requirements that one of the trustees must be a U.S. citizen, thereby conferring the right to in the QDOT, you have one citizen trustee that gives jurisdiction to the USA, and if you don't have the U.S. citizen being the trustee, then the Qualified Domestic Trust fails, and all of the estate tax is due presently. One way around that we frequently use, we find that the surviving spouse is not really the intended beneficiary. So if you have a husband and wife and they have children, and let's say the wife is the non-citizen, then if all the assets go directly to the children, there's no estate tax due, and the Qualified Domestic Trust is not necessary. So some definitional points. Oftentimes the terms are mixed and inappropriately applied. The term, as I use it, the estate, when someone dies without a trust and they have assets in their own name, an estate is created. And when somebody has a revocable trust, on their death, the trust most often becomes irrevocable and non-changeable, and then that creates the distinction between estate and trust. So when someone dies, they may create two entities, one being an estate that needs to be administered and file tax returns, the other being the trust that has income and must file tax returns. Now, in California, if you have an estate greater than a fair market value of $184,500, then in order to transfer title to the property, you need to have a probate. And the probate in California is quite lengthy. It might end up taking a year and a half, 2 years. The attorney fee and executor fee may be $30,000 or $20,000 each. It's quite time consuming and expensive. And for that reason, that's why the majority of estate planners use trust as a primary estate planning instrument. Recently, we have a new law that exempts a personal residence that has a fair market value of less than $750,000 from having to go to probate. So that's after April 1, 2025. And the property values in California are so high that it's not going to be a great number of people that are going to have that situation of avoiding probate, but it's something to keep in mind. Okay, so we have, let me see where I'm at here. So we have a credit verification checkpoint on the screen that needs to be handled to get the credit. Let me refresh here because my screen's not showing the slides that I need. Now, for gift tax, that's an IRS Form 709. So you have this lifetime exclusion. We said 14 million, next year 6 million before estate tax kicks in on market value of an estate. And then there's another ancillary form that needs to be prepared, and that is a Form 709 if you give a gift over $18,000 per recipient. And so husband and wife can give $36,000 per recipient per year. And the purpose of that is to bring down that 14 million exclusion and have money escape from estate tax. So the example being John D. Rockefeller, when there was estate tax, he just gave all his money away before his death. And when he died, there were no assets in his estate, no inheritance tax. So he did an end run around the estate tax, and the Congress didn't like that. And they passed the rule about gift tax reducing the exclusion. When someone dies, we have a great opportunity because the asset was subject to estate tax. You get a step up in basis for all the assets in someone's estate. So if you had a house, for example, in Orinda, California, and it was purchased 40 years ago at $200,000, and now it's worth $1 million. If the owner of the house, while they're alive, sold the house at $1 million, then they'd have an $800,000 capital gain. If the parent, in this case, left the property in their estate and transferred it to their heirs at their death, then the value of the property goes up to $1 million, and the beneficiaries, if they sold the property shortly after death, there would be no gain or loss, and the capital gain would be none. So we recommend that people do not give property to their beneficiaries while they are alive, because a gift basis to a beneficiary is the same basis as in the donor. My example here is this house that we had with a cost basis of $200,000. If it's gifted before death, the beneficiary has a cost basis of $200,000. If the asset was gifted or bequeathed after death, then it goes up to the fair market value, which is $1 million. California has no estate tax per se. It was repealed quite a while ago in around 2007, but they have another tax that is more insidious, and that comes from Proposition 19, and this I call the hidden estate tax in California. So there was a proposition a few years ago where it was deceptively worded and confused the voting public that the exclusion of property going to kids would not get reassessed for real property taxes. And in this proposition that was passed, it extremely narrowed and caused all real property to get reassessed at death. And it can have an impact. We've seen properties where before death, the real estate tax on an annual basis was $2,000, and after death, it went up $10,000. So it's really draconian, and part of the sponsors of this proposition was the California Association of Realtors that helped the deceptive Prop 19 get passed. And when people can't afford the high real estate tax after death, then maybe they should sell the property and call their real estate broker. The one way around it that we use frequently is the parent-child exclusion. And what that does is it allows the beneficiary, the child, to inherit the house and claim the parent's lower property tax. Both the parent and the child have to live in the property as their principal residence, and then the beneficiary needs to file a claim for exclusion under the parent-child exclusion with the county assessor's office. And there's another form that must be filed with it called the homeowner's exemption. The homeowner's exemption certifies to the assessor that the child inheriting beneficiary is living in the property and therefore qualifies for the lower property tax. When someone dies, we have several tax returns in process. One, we might have an estate 706 tax return filed with the IRS. The next return that we always have to do is the 1040, the individual income tax return. And all the income goes from January 1 in the year of death till the date of death. So we prorate all income to that point. Then the day after date of death, the estate has the income, and then we file an IRS Form 1041 when the estate has income over $600,000 for the year. And because the estate is a separate legal entity, we have to get a federal ID number for the estate in order to do the estate income tax return. And this ID number is different from their irrevocable trust, non-changeable trust. So there can be two ID numbers needed when someone passes away. In the estate income tax return, IRS Form 1041, there are compressed tax brackets, which means a steep increase in income tax as the income goes higher within the, they call them a 1041 tax return or fiduciary tax return. So when the trust or estate's income exceeds $14,450, the tax bracket on all the other income is 37% on all that income. And that tax bracket, 37% for an individual taxpayer filing a Form 1040, that 37% bracket does not start until $609,000 of income. So you can see that the estates and trusts pay a much higher tax bracket, and President Clinton was in office when this rule took effect, I feel, because they felt that trusts and estates don't vote. So what we do in tax planning is we try to avoid the higher tax by distributing the income out of the estate or trust and into the hands of the beneficiaries. The IRS Form 1041 is the tax return, and then Schedule K1 is used to allocate income among the many beneficiaries. And when we do that, the beneficiaries end up paying less tax with a lower tax bracket, and the overall estate, trust, and beneficiary combined group pay less income tax overall. So we always try to distribute the estate income to the beneficiaries, and we can do that except with capital gains cannot be distributed until it's the final year of the estate or trust. Capital gains, to try to get the money out of the estate income tax return, we can make distributions to the beneficiaries up to 65 days after the year end, and the IRS allows it to be reported in the prior year to reduce the estate income tax return. Because we have a problem of two different entities being created at death, if the estate has assets and the trust, irrevocable non-changeable trust, has assets, and they both have income over $600,000, then two tax returns are needed to report it to IRS. However, there's a form, IRS Form 8855, that you can make an IRC code 645 election, and it allows you to take those two separate tax returns and report them onto one tax return, and it's called an administrative filing, combining the two entities, and it saves a lot of paperwork. So in-kind distributions have to do with, instead of selling all the assets, you distribute the house out to the beneficiary in 3 or 4 beneficiary names. You don't have to sell it. That's often a good way to keep assets within the family. Distributing in kind helps avoid capital gains from sales. It also, when real property, we have to get an appraisal for the house after death, so we can use it for all kinds of purposes, for the income tax return for the estate, and then if the asset is distributed in kind, then the beneficiary needs to be notified of the value of the asset being distributed, and that's where the appraisal comes in. With brokerage accounts, it's a little bit more difficult because of the number of investments. So we're talking here about step up in basis under Code Section 1014. To help clients in the brokerage area, they've got my same example of dollar value, 2 million, bought the stock portfolio, and now it's worth 10 million. You need to make sure that the stock brokerage firm knows of the death of the owner, and you ask the brokerage house to give you a valuation of all the stock values at the date of death to increase the basis, and that will reduce capital gains on future sales. And you need to verify this with the broker that that's been updated, because we've seen quite a few problems where the broker did not increase the basis on death and later causing 1099s to be issued on stock sales showing gains when there were none. So we verify those each time. So cash flow issues, some people will avoid transferring assets by a trust or will by using transfer on death accounts, TODs. And that is a way to avoid probate and not have a trust, but there's some drawbacks. And that is when the person dies and the asset is transferred out to the beneficiary, the estate is left with less cash to do its job. The same thing happens on joint tenancy property with right of survivorship. We recommend not using extensively the transfer on death accounts or joint tenancy, and put the assets into the trust so that the assets are there for operating needs of the trust administration. I get questions frequently whether inheritance is taxable. Every beneficiary assumes it is, and they want to know how much that tax is on their inheritance. They're always surprised to find out there is no tax on inherited property coming from a trust or estate, with some rare exceptions, one of which is if the estate was so large that they had estate tax due, and then they made a distribution without paying that estate tax. In some rare cases, the inheritance tax would go to the beneficiaries under the theory of transferee liability. So after having said that inherited gifts are not taxable, now I have to qualify it because there are some exceptions. Inherited IRAs, inherited pensions, inherited annuities are taxable to the beneficiary. These are separate trusts, and when they're inherited by a beneficiary, they were tax deferred, and there is still the capital gain or income feature within that account. And that assumes that, let's say someone inherits an IRA, they get the IRA, they immediately take the money out and put it in their own account. All that IRA money is now taxable to the beneficiary. However, if the beneficiary does not take the money out, they create a beneficiary IRA and they roll the money from the inherited IRA to the beneficiary IRA without touching a penny of the money, then there's no tax immediately. However, the beneficiary has to take the money out of the IRA before 10 years passes. So it's a way to defer the tax if the funds are rolled over.
Hi, Rex.
Yeah.
Your section was only for 30 minutes. We have reached that, but we do have some questions from our attendees.
Sure.
And one of the questions is, if the client files a 709 and the estate tax drops, does the gift go under the year gifted or the year when the client dies?
As far as I'm aware, I don't have the exact answer to that question because of the changing rules in estate tax next year. But my understanding is that reduction in the exclusion stays in effect and will reduce the exclusion in future years. So I hope that answers the question.
And then we have one more question. It says, what is the tax rule regarding setup in basis or tax basis when an elderly parent adds a child to the property title before father's death? What is the child's basis for capital gains after the father dies?
Okay, this is the reason why we don't like people given property before death. It's called a gift basis because the basis in the donor is going to transfer to the donee. There is no step up. So that's the reason to let the property transfer after death, and all capital gains are forgiven. So I hope that answers it.